Welcome to this Killik Explains finance video. This week, could booming car loans, a particular type of loan called a PCP, trigger the next crash? Well, it's been in the news recently. In a nutshell, the Bank of England is concerned. They're concerned that UK consumer credit is growing and now stands at just shy of 200 billion sterling. Of that, around a third is car financing of one sort or another, and the bulk of that is this thing called the personal contract plan, which has become massively popular over recent years as a way for people to buy new cars without putting down the full purchase price. Why are they worried, and are they right to be? Let's take a look at that right now. Now, who is owed what? Well, basically, the Bank of England reckon that manufacturers, so they can set up these PCP things, whatever those are owed around 34 billion in sterling, and banks are owed around 24 billion. So those are the two main lenders. But what is the kind of deal we're talking about here? Well, a PCP, as I will call it, is basically this. In the old days, if you wanted a car, you usually got an on-the-road deal for it. £12,000 down, drive it away. These days, you're more likely to get something like this offered to you. Drive away a new car for as little as £249 per month, with a load of small print at the bottom. And that kind of arrangement is what PCP is all about, and it accounts for around 80% of new car sales, according to the Society of Motor Manufacturers and Traders. So clearly, whatever it is, it's big and it's been growing pretty fast. So what exactly is this deal? Now, PCP is essentially a way to buy a car, drive off the forecourt without putting down the full purchase price. In fact, without putting down anything like the full purchase price. So the three components are an upfront deposit, can be very low, can be as low as £1,000. Regular payments over a fixed period of maybe 2-3 years then follow, and you get this thing called an optional balloon payment, and that is quite a key feature of these deals. And we'll look at that in just more detail in a moment. That is designed to keep people locked into this style of contract. Now, let's take a look at that. So you want to buy an £18,000 car. Made up the numbers here. Let's say you're required to put down a £2,000 deposit up front, and you hand that over to either a manufacturer or a bank. Then they ask you for 36 monthly payments, so 3 years worth of payments based on a loan of £8,000 and a balloon option payment of £8,000 at the end. So quick check, £8,000 there, the final payment £8,000 there, as a sort of interim if you like, and £2,000 there is the £18,000 original purchase price. So far so good. So you pay the deposit, you keep up those payments as required. On the other side of the deal, you've got a manufacturer or bank taking the deposit off you up front, taking payments. Now those payments will be structured to cover the depreciation on the car over the 3-year period, let's say, broadly speaking, and then they give you a choice after 3 years. Now here's where the media gets it wrong sometimes. As the consumer, there's quite a lot of choice about what happens when you get to the end of the 3-year period. So, you've got the car, after 3 years, what are you going to do with it? Number one, you could buy the car for that balloon payment. £8,000, in a nutshell, pretty much clears your debts, keep it then, or sell it. You could sell it on the second-hand car market, for example. Or you could hand back the keys. Now, you might be charged what's called over mileage. That's if you've driven more than the agreed mileage up front, and you might be charged for damages, but essentially, let's assume you're not. You could simply more or less hand back the keys and sort of walk away from the deal. And that's the bit that some aspects of the media sometimes overlook. The third thing is you can use equity to buy another new car, drive another new car for forecourt, and that's what the manufacturers are kind of hoping you'll do. So, what does that mean? Where does that equity come from? Well, it's the idea that, let's say, the dealer or the manufacturer estimates that after 3 years, the value of the car will be around £8,000. It started at 18, it will be 8. And actually, it turns out, when you get to 3 years' time, the second-hand value is £9,000. If you carry on, in other words, if you sign a new PCP deal, and they're hoping maybe you'll sign one for a bigger car because you can afford a bigger car by then you get effectively £1,000 worth of equity to put towards the price of the next car. And they're kind of hoping, the manufacturers, that you'll keep signing these deals after, let's say, 3 years and building up equity, assuming the value of used cars doesn't plummet. And that's an important caveat I'll come back to. Now, the upsides, therefore, it kind of is a win-win in a way, because as a consumer, you pay a fraction of the cost of a new car to drive it off the forecourt. You pay a reasonably competitive APR on the loan payments I described over that 3-year period, let's say. It doesn't have to be 3 years, but it could be. 5 to 8% is typical. I'm not going to guarantee you'll get 5 to 8%, but the amount is usually substantially below unsecured credit card debt, for example. And if you build up cumulative equity, if you manage to, you can use that to sort of move yourself up the car ladder. On the other side, the car manufacturers and banks setting up this deal, if you like, on your behalf, they get to sell more new cars. It's a good way to lock you in, they reckon, to moving up their car chain. All right, so you buy their bigger and better cars as you keep re-signing these PCP deals. And the APR on the PCP, they would say, covers them against depreciation over the period of the loan, and they estimate the balloon payment as sufficient to cover them should you decide to opt out at that point. So, in theory, a win-win. So why are people worried? Why do the media pick this up? Why is the Bank of England nervous? Well, Bank of England's point is this. They say that basically there is a risk of credit being extended using PCP to consumers who cannot afford it. The bigger the market gets, the more scope there is for slightly less scrupulous lenders to get involved, is the argument. Consumer credit default risk is much higher than it is on home mortgages, and there's a risk of a collapse in the used car market. So you might suddenly find manufacturers faced with people handing back car keys, handing back cars if used values plummet. More of a problem for the manufacturers, you might say, than the consumer. And there could be a knock-on effect, and this has been focused on in the US in particular, where you've got these slightly less scrupulous lenders creating what has been described as another subprime effect. You know, cars being sold to people who can't afford them on terms they can't afford, a whole thing could blow up further down the line. But on the flip side, now you might say they would say this, but they've actually got a fair few points here. The manufacturers and banks in this country would say, well, actually, PCP loans are underpinned by a real asset, a car. They're not totally unsecured, so they're not as risky as some forms of debt. Car prices are predictable, and balloon payments are set at a cautious level below the estimated second-hand value of the car. So the chances of someone not carrying on are relatively small, goes the argument, and the manufacturers are covered. There's little evidence of widespread loan distress yet. In fairness, the Bank of England are always looking ahead. And the debt market is relatively small versus, say, the consumer mortgage market. Okay, so to conclude, where does this leave us? Well, for UK borrowers, so for the people like you and I perhaps signing these deals, let's say, cars are a must-have for many consumers. So the argument against a crash, if you like, is the fact that people will hang on to their cars if they possibly can, because we're a car-owning nation. Average APRs are fairly low, so the loan rates are above mortgage rates, let's say, but nowhere near credit card unsecured debt rates. Buyers do have a get-out-of-jail-free card. They can choose to hand the car back, subject to high mileage, subject to damage, and so on. And subprime lending, even in the US, appears to be a fairly small percentage of the total. Meanwhile, on the lending side, who's exposed here? Well, banks would say not too bad at the moment, because even according to the Bank of England, only 7% of household debt is accounted for by these PCP agreements, although the market has been expanding rapidly in recent years. But for car manufacturers, there I'd say there is potential risk, because were the second-hand car market to kind of implode, suddenly you'd have a flood of used cars on the market. That would hit prices, that would hit profits as residual values plummet, and as competition for new financing hots up, you're going to find that their margins are squeezed anyway. So short-term gain for potentially longer-term pain for the car manufacturers themselves, and that is certainly a spot worth watching if you're an investor. So there we have it. Probably not time to panic just yet. Understandable why the Bank of England's got its eye on this space. Be careful with slightly misleading media headlines about how bad the problem could or might be. Editor at Killik.com for queries. And if you want to see any background videos relating to this one, Killik.com/learn.